The ultra rich do some really powerful and cool things that anybody could do if they just knew about it. In particular, with estate planning. We're going to talk about how estate planning helps you reduce taxes, how it helps you protect assets, and how it helps you protect the people that matter most to you. One of the ways that we help accomplish those three goals of reducing taxes, protecting assets, and protecting the people is through trusts. There are two kinds of trusts, generally speaking, revocable and irrevocable. And a lot of people struggle with what's the difference and why do I need one or the other? Generally, a revocable trust is included in your taxable estate and available to your creditors. It does not protect your assets unless you die. An irrevocable trust, on the other hand, is a trust that's outside of your taxable estate and not available to your creditors. So it can be a powerful device for protecting assets and for minimizing taxes. So we can use these trusts to manage tax brackets and to protect assets from creditors. So let's talk about how we can do that. So with a trust, trusts have beneficiaries. And the taxpayer may be the grantors of the trust, they may be the beneficiaries of the trust, or they may be the trust itself. Which taxpayer is at the lowest bracket? Is that the grantor? Is that the beneficiary? With a well-crafted trust, we can pick who the taxpayer is going to be and we can manage that. One of the things that we do for effective planning is between this revocable trust and irrevocable trust, we build a bridge, usually comprised of business entities. For example, a lot of people will use an LLC, a limited liability company, and the most common device, the most common way of using a limited liability company is a single member managed LLC. And what does this give you? It doesn't give you as much as you might think. Inside the LLC is going to be contained. So if that LLC owns a dangerous thing, a property where liability might occur, that liability for that dangerous thing is going to be contained with that LLC. It can't get out. But outside liability, in some places and under certain circumstances, can get in. So while there is some limited liability, there's not absolute limited liability. A couple of things we can do to dramatically ramp up the asset protection of that limited liability company is, one, have more than one member, multiple members, two members. Another thing is to have a third party non-owner manager, a manager-managed thing, and we'll talk about how that can happen. So where are we going to get this other member? Could we have family members? Well, you could, but if you name a person as that second member, people have people problems. People die, they get sick, they become incapacitated. So those people problems can contaminate, hurt, hold up, complicate, make operating the LLC difficult. So it's rarely a good idea for people to be the members. It's usually best if the members of that LLC are either a trust or another entity which is in turn owned by the trust. So if, for example, that second member is an irrevocable trust for the benefit of your children or grandchildren, now you have a second member that is, by its very nature, unavailable to your creditors, unavailable to the creditors of your children and grandchildren. So if they have people problems, which most people have people problems, those people problems are not going to come back and bite your LLC and cause complications or difficulties for it. It's also a good idea, if you want to level up one more level, both for asset protection and for tax planning, for there to be a third party non-owner manager. Typically, in this instance, we like to use a management company, and that third-party manager, the management company, is not an owner, should not be an owner most of the time. All it does is manage. So what can we do with the tax liability? We can direct it to the most tax-efficient place. We can direct it to the management company, where it can be expensed for legitimate and qualified business deductions. We can, through the company that owns the underlying assets, we can direct it from there to the trusts, and from the trust it can flow to the people who will typically be at lower tax brackets. So we have the ability to direct the tax liability, again, to the most efficient taxpayer. Now let's think about capital gains tax. It's kind of a quirky tax. It's an invention of politicians, and it's very clever. If you buy an asset, you have a cost. If you depreciate that asset, your cost basis goes down. And over time, the cost, not the value, the cost of that asset is going to go up. What do we call it when the cost of something goes up but the value stays constant? We call that inflation. So politicians build in this inflation on purpose, and that gap between what you paid for it and what you have to sell it for today because the value of the currency has gone down, that's called capital gain, and that capital gain is taxable. So it's a tax on inflation. Isn't that cool? They cause the inflation and then they tax it. Well, there are ways to avoid that. One of the ways to avoid that is through a charitable device called a charitable remainder trust. With any kind of property, you can divide it up in several ways. If it's real estate, you can put a fence down the middle and somebody on one side owns part of it and somebody on the other side owns another part of it. So you can divide it up spatially. Another way to divide up assets is between their income interest, their present income interest, and their future residual value when you die. And that's what we do when we employ a charitable remainder trust. We divide an asset up between its income interest and its residual value at death. And you're going to keep one of those and you're going to give one of those away. Now, most of the time, the piece you're going to keep is the income interest. And you're going to give away the residual interest when you die to charity. And we'll talk about how to do that in a really cool way here in a second. Because you're only giving away part of the asset. When you form this charitable remainder trust and put that asset in, you only get a tax deduction for the part that you're giving away. Now, this charitable remainder trust is, by its nature, out of the box, by statute, by code, tax exempt. It's a charity. And by the way, this is not exotic. It's not bleeding edge where, oh, this is a new thing that they're experimenting on and I might get hammered by the IRS because they disagree with what I've done. No, 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 no. This is long, old, well-established, lots of rules, lots of case law. So if we follow the rules and stay between the ditches, you can use the charitable remainder trust and stay out of trouble. So you form the trust, you put your highly appreciated asset in this trust. You get a bit of a tax deduction for it. Then the charitable remainder trust sells the asset. Now, timing here is critical. The trust has to be formed and it has to be funded before the sale is documented. If you have a sale already in process, what do you have to do with that sale? Cancel it, tear it up, throw it away, start over from scratch. So the charitable remainder trust becomes a seller, and the charitable remainder trust is tax exempt. So all of that income that would otherwise be subject to capital gains tax for the charitable remainder trust is not taxed because it's tax exempt. So the entire proceeds of sale come into the charitable remainder trust. And what's going to happen with this? You're going to invest that money and you're going to put that money to work. And when that money produces an income in the amount that's determined by law, by the terms of the contract, that income is going to pay out to you. Now the tax liability follows the income. When you get that income, you pay a tax on it. That income is taxed on a worst in, first out basis. So worst in means the first income that comes out is ordinary income, second income that comes out is capital gain if there is any, third income that comes out is tax-free. So if you have muni bonds or some tax-free kind of investment that comes out, the last thing that comes out is principal. So worst in, first out comes out to you and you pay the taxes on that. Bummer. It's not that bad. If you have to pay a lot of taxes, that means you did pretty good that year. Okay, so let's review some cool things we've talked about here. Estate planning is way, way more than just deciding who gets your stuff when you're dead. If you're doing a complete, what we would call an integrated estate plan, you're going to get tax benefits, immediate ability to plan your taxes and direct the income to the most tax efficient party. You're also going to get asset protection. And the third benefit, of course, is then succession planning, not only of your wealth, but of the people. So if this was helpful and you want to find out how to use the law to your own advantage, we call that proactive law, sign up and subscribe to our channel. You'll get more content like this. We have more to come. Our firm is taking new clients. We're here. We want to work with you. So if you want to work with us, you can sign up for the wait list. The link is in the show notes.